So as we've been talking about all morning, social media stocks swooning overnight and biotech shares also getting bruised after the Fed said valuations in both of those sectors are looking stretched. Let's get right to Dorland for Value Add, Chairman and Chief Investment Officer, CIO at Landor Infused Capital Partners. He joins us live on the line from New York. Dodge, good to talk to you again and always appreciate your time. So, there's two ways you can look at this. When Janet Yellen says stuff like this, either A, you get worried or nervous, or B, you're kind of thankful because, she's come out publicly to say that that's right, I missed the housing bubble. But hopefully, if she's trying to make up for that this time, this is a pretty good heads up.
Yes, it is, Martin. Good morning. Well, we do see some increased volatility with the social media stocks. We see less upside and more downside potential for the short term because of her comments. But let's remember, the Fed is neither responsible nor should it respond directly to asset inflation. So it's more of her comment on the market, a warning, and the market's going to reflect that.
Okay, Dodge, as Martin said, we've been talking about this throughout the show today. And in fact, we've been asking our viewers what they think when it comes to this, these commentaries, or these comments, rather, from Janet Yellen. Paul has written in saying, you know what, this is 2000 all over again. He said everyone knows it's a bubble. Countless experts coming out saying valuations are extreme. Nobody cares. Nobody listens. He's got a few other comments to make, but his bottom line here is smart money is shorting the hell out of this. What would you say to Paul?
Smart money is not shorting it yet, but is not going long. It's waiting for the market to make up its mind. Smart money, short term, is trying to take advantage of the volatility. Ultimately, the Russell 2000, the small cap stocks, is the weakest of all the major market indicators that we have over here. It's very close to breaking down. We're watching 1150. If that does break 1150, then we will see further deterioration in the social media stocks. Of the social media stocks, we think Twitter has the most downside pressure. I don't think they're shorting to the degree that he is mentioning yet, but the eyes are more on the short side than on the long side.
So, Dodge, you're 3 points shy of that 1150 level on the Russell 2000. What you're saying is we break below that, stay below that, or God forbid go further south. That's your signal to start bailing.
That's the signal, Martin, that the market as overall is beginning to find weakness and to find additional momentum to the downside. We would watch the other four, the Dow Jones, the S&P 500, and the NASDAQ, to see if it confirms. If the Russell 2000 is the only one that breaks, then there's a positive divergence and the market will find support. But if the S&P 500 and the Dow start to join on the downside, then yes, Martin, there probably is more of a pullback. And we're going through a season now that is quieter as opposed to more activity, and so it'll be easier to have a pullback, and the market expects it, so it's just fulfilling its prophecy.
Mm-hmm. We were talking about a stock called Yelp this morning, Dodge, with Jules, who pointed out 12-month forward PE over 2,000. That's got to be overvalued, hasn't it?
Yes, absolutely. In fact, Yelp is one of the weaker social media stocks. It is now trading below levels of short-term investor support, short-term being the 50 and the 150-day. It could definitely be one of the ones that would drop 3% to 69.02. We see support at 66.80 short-term, but really the level we're watching now is 60. If it breaks 60, then there's a technical pattern that indicates that there's more downside risk.
Okay. All right. Dodge, always a pleasure to have you with us today. Thank you so much for joining us today.
PE, one word, 4 letters, sounds like my dogs.